Hi, everyone. Welcome to IP Strategy for an Exit, an M&A or an IPO. My name is Nicole Owens, and I'm the Director of Marketing Communications for Medtech. Those of you who are not familiar with Medtech, we are the largest medical device trade association in the US, dedicated to growing our ecosystem in New England. Today's program is going to be really valuable and exciting. We have Greenberg Traurig here with us today, and I am pleased to introduce David Dykeman, shareholder, and he's also been on our board of directors at Medtech for many years. So we really appreciate the support. And I'm going to turn it over to David in just 1 second. Quick housekeeping note. We are going to allocate time for Q&A, so please do enter your questions in the chat function below or the Q&A function. And this webinar is recorded, so everyone who registered for it will receive a copy after the webinar. With that, turn it over to David. Take it away. Thank you.
And thank you, Nicole. Thanks for that warm introduction. Hello to our audience across the world. We saw the attendance list, and we've got people from all over the US, Canada, and even a little further away on this webinar. So we're very excited. It's one of the benefits of webinars versus in-person programming. As Nicole mentioned, my name is Dave Dykeman. I'm a patent attorney at Greenberg Traurig. I co-chair our firm's life science and medical technology practice, and really medical devices are my sweet spot. It's the sandbox I play in, and I'm very excited to help organize this webinar for you today. And it's really going to be a great webinar. So there you can see who I am. I've got a few more gray hairs in the picture, but that's what happens actually. So, and what can you do? And Greenberg Traurig, we're an international law firm. We have 43 locations. We just opened an office in Charlotte last week, and Singapore is coming in the next few weeks. So I think that's the breadth and depth of where we are. We have more offices in the US than any law firm, but we also are in all the international places that companies want to be in. So our life science and medical technology practice is very deep. Now I think we have over 150 lawyers practicing in life science and medical technology, 22 offices around the world. Our marketing team likes to tell us we're racking up some awards, but that's really due to our clients. We're working on some of the best and biggest deals out there. And we cover the full range of medical devices, healthcare technology, digital health, and of course, biotech as well. So we have a great panel today. Really excited about this, and the timing could not be better. The highlight is really Jeff Mann. Jeff Mann and I go back, gosh, about 20 years now when we were both baby lawyers. We worked together at a firm here in Boston. I continued at the law firms while Jeff went in-house and had an illustrious career at Boston Scientific for nearly 15 years. Then he was also in-house at Cantel Medical and led their sale to Steris. And he joined Becton Dickinson and spearheaded the public spinoff of embecta, which just happened on April 1st, just a few short weeks ago, where embecta became a separate public company that's traded. And their stock is holding up very well so far in the first few weeks. But we're really thrilled to have Jeff on the panel, and his stories about leading M&A, leading a public spinout, being at some of the biggest medical device companies of the world are really going to be helpful. Jeff has a background in IP and corporate. He's a real unique lawyer in that respect, and it serves his companies well. Our other panelist is Roman Fayerberg. Roman Fayerberg and I are both patent attorneys at Greenberg Traurig. We've practiced together for 12 years. Our offices are right next door to each other, although we're both logged on separately now for this webinar, in a COVID irony. But Roman does medical device patent law, and he builds on that career after working at some of the biggest medical device companies as an engineer. So we're going to hear from both of them shortly, but let's see what we're going to talk about today. When Jeff, Roman, and I got together, we really want to talk about what is the medtech landscape. We're going to look at M&A, IPOs, and how do you position your companies to take advantage of really a medtech industry that's on fire right now. The deals are in the billions. The headlines are amazing, but they don't happen overnight. And how can you do things in the early portion of your company that position it for success 2, 3, 5, 6 years down the road? All these deals that we're going to talk about, they're years in the making. And a lot of things happen correctly, and you don't know it at the time. So we're going to try to give you those lessons so you can incorporate those into your company and deal with that as you do the IP due diligence with the big boys and ladies who want to buy your company, and go from there. But I think with that, we're going to hear from our panelists. I'm going to ask Jeff Mann to give a little bit more about his background in the industry and some of the trends he's seeing in medical device and medical technology. So Jeff, it's just like when we were young associates, but now the floor is yours.
Yeah, thanks, Dave, and thanks for having us. Special thanks to MassMedic for including us in this great opportunity to get together. As Dave said, we've been working together for over 20 years, and not coincidentally, those first two projects were M&A diligence exercises, one for a pharmaceutical and one for a biotech. And if there's one thing that, you think about the years that have passed since 1999, there's a lot of things that have changed. We've had a pandemic and lots of things in the global sort of geopolitical and social environment have changed, but the one constant for M&A has been an important piece is doing IP diligence. That is, it's not stylish and it's not fun, but it is absolutely key and probably the longest longest pole in the tent for all of us that do M&A to really go through it and understand when we're acquiring or we're getting ready to put something out in the market, whether it's a spinoff or an IPO. The common denominator there is being very thoughtful about the IP strategy. And I think the biggest challenge you always find is, it's easy to shortcut IP because it's over the horizon, but it's impossible to catch up, right? So launching a product, collecting the inventions, making sure you have your assignments, making sure your house is in order is really a day one exercise for somebody looking to do an exit. And on the acquisition side, making sure you've got a strategy for identifying the core IP, doing a clearance, understanding the technology is a day one assignment for the acquirer side or the sort of banker taking somebody to an IPO. So on both sides, it's early work, it's hard work, it's not inexpensive work, but it's absolutely worthwhile. And we'll talk about more, but I think the other piece on that is always making sure that you're being honest. There are things that you're going to make decisions about. And I think one thing you'll find in the more sophisticated acquisition sort of markets is people understand decisions are made and when they're made, as long as they're being brought along with the story and they understand the context. Nobody likes surprises. The chairman of our new board, it's actually his rule, the law of no surprises. And I think that will be the conclusion that we have at the end of this hour, which is whatever you're doing, make sure that it's a conscious decision. It's not just a lack of resources, but you're very deliberate. When you're in a diligence exercise, be transparent and thoughtful about the information you share. And if you're on the acquisition side, make sure that you're ahead of it and communicating with the business partners, not just what the IP issue is, but what does it mean in the context of running the business. For me, I got to this point, as Dave mentioned, I went in-house after 5 or 6 years at a firm doing generic pharmaceuticals and paragraph 4 and litigations. Went in-house to a urology business at Boston Scientific, and after a couple of years, really thought I knew the business. But I started adding businesses and realized the more I learned, the less I knew. That every business is different, and the needs of the business are different, and the way IP is applied, it's the same set of laws, gets applied in each business is different. After BSc for 14 years, went on to Cantel Medical, which was a very diverse business in hemodialysis, dental, and medical. That had a very different IP flavor. And now at the spinoff from Becton Dickinson, where we're selling syringes and pen needles to over 30 million people living with diabetes per year. And that has its own flavor. And I saw Bob West, I'll give a little shout out to Bob for his hard work on behalf of the diabetes team here, formerly at Becton Dickinson, for great IP work by a tremendous patent agent who really took the time to understand the business and what it needed. So with that, back to you, Dave. Dave, I think you're on mute.
Jeff, that's why you're a good partner to have on these. But thanks, Jeff. No, we're grateful you can be here, especially just a few weeks after becoming a public company. And I think the other panelist is a great compliment as well. Roman Fayerberg's background complements many of the companies you talked about. So Roman, why don't you tell us your background and what trends you're seeing in terms of IP? You're on mute.
Same thing.
Yeah, I know. We work together so much. We make the same mistakes. But thanks, Dave and Jeff, and welcome everybody. So I'm a patent attorney and shareholder in Greenberg Traurig. I started my career as an engineer, R&D engineer, kind of followed very similar trajectory as Jeff. I started my career at Boston Scientific, working on neurointerventional systems like stents, catheters, stent delivery systems. And then I moved to what was then CR Bard, which is now Becton Dickinson. I worked there for 5 years on hernia repair product and hemostasis products. And after 5 years, I went to law school, started my career in New York for a few years, and then moved back to Boston to Massachusetts and joined Greenberg. And as Dave mentioned, it's been almost 12 years we've been working together. My background is very similar to Dave's, and kind of given my experience in engineering, I do most of my clients in the medical device industry. It's the industry I know. I really enjoy it after all these years. Very exciting seeing all the innovations in the industry. But my practice, the core of my practice is working with kind of the companies, help them strategize, build patent portfolios, kind of help them set themselves apart from competition and set them up for, whether it's an investment or an acquisition, an IPO. But the other part of the practice is we work, obviously Greenberg Traurig is a large corporate firm, so we represent a lot of acquirers and M&A investors. And so another part of my practice is doing due diligence, IP due diligence on the companies. And, the last few years, as we'll talk about, been very busy. And, the trends we see is obviously everybody knows they need the patent portfolio, but as we look into the other companies, what we're trying to see, as Jeff mentioned, is we want to see a story. We don't want to just have you see 100 patents, but none of them cover the product, only one cover a product. We want to see some kind of strategy that, if you just, what was filed, how the claims are written, why they're written this way, that the product is protected in many different ways that you have for medical device. Maybe you have the device claims, system claims, maybe some method claims, which, maybe not as valuable, but you still have those kind of different multiple levels of protection. And again, being able to tell this story, this is why what we file in certain patent, and this is what we're trying to cover, and this is how that translates to our commercial products. But yeah, so I'm looking forward to kind of discussing. It'd be interesting to hear Jeff's perspective on the due diligence as an in-house attorney.
So perfect. And I'm going to set the table now a little bit, and then we're going to get right into the discussion. And we talked about the agenda, but even the title of this program is IP Strategy for an Exit, M&A and IPO. And one of the first questions we got, which we do encourage, is how can you combine M&A and IPO? They're two different transactions. One becomes a public company, the other involves a change of control. The reality is, you need to view that as the exit, but you're in a long journey before you get to either an M&A or an IPO. And they are both forks in the road, but you're starting your company or even when you get clinically approved, you're still a ways away from any exit, whether it's an M&A or an IPO, and you need to prepare your company for both contingencies. The key now for all CEOs and boards is optionality. While you might say my company is going to be going public, that's great, I'm targeting 23 or 24, you don't know how the markets are going to change. You don't know what's going to happen as we're seeing this year. You know, the last few years have been banner years for IPOs. This year, it's certainly a more challenging market based on global factors that you can't control. You know, a war in Ukraine and Russia that nobody could have accounted for is shaking up the agenda. And a lot of companies had plans to do IPOs, but now they're getting delayed. And maybe they'll end up doing an M&A instead. So I think they really are more similar than different. They're just which exit of the highway are you taking, but you have a long drive on the highway before you get to any exit. So to set the table on where we're at, we thought we'd look at what are some of the major IPOs that we've seen in medtech. Last year was a very good year. These are just a few of the biggest highlight details, and you can glean some trends from them. You know, the first bullet there in green, Ortho Clinical Diagnostics, diagnostic test company, obviously COVID, you can think about that. They went public in January of 21 for $1.3 billion, an excellent IPO. But look at what happened less than 12 months later in December. That's a typo, actually, in December of 21. So 11 months afterwards, they went public for 1.3 and they were acquired, taken private by Quidel for $6 billion. So think about that value creation. The IPO created $1.3 billion in January, and then in December, the company sold for $6 billion. And you look at what else was hot last year. Telehealth, $650 million IPO in February for Signify Health. Doximity, social network for doctors, a $600 million IPO in June. And then more kind of tests and more traditional device developers, point of care infection test company, Talis Biomedical, a $250 million IPO, also in early 2021. So I don't know, Jeff or Roman, any thoughts about how the public markets fared in 2021?
Yeah, I mean, obviously a lot more interest, I would say, in talking with our bankers. You know, we're hearing, as you foreshadowed, a lot of companies who thought there was an easy path to an IPO, even the SPACs. A lot of folks are revisiting the strategy, which, to be honest, I think makes a lot of sense. And when you look at the overhead that you have to carry as a public company, the requirements, the disclosure for companies, particularly in the innovation space, who are doing a lot of IP filings and a lot of R&D, it's hard to do that as a public company without a lot of revenue to support it. So I would view the 21 to 22 as sort of a natural adjustment to right size to, you know, who really belongs in an M&A sphere versus an IPO sphere.
So I think that's a great observation from the bankers who are driving a lot of these deals that we saw in 2021. And you also look at M&A in 2021. It was a banner year. Look at these headline grabbing deals that we've seen. You know, led by the Siemens Healthineers, acquired Varian Medical for $16.4 billion, closed in early 2021. Baxter acquires Hillrom for $12 billion, right at the end of last year, right before the holidays. You know, Steris acquires Cantel Medical for nearly $5 billion in the middle of the year. We might hear a little bit more about that deal in a minute. And then the SPACs, as Jeff mentioned, you know, the SPACs are a merger that leads to a public company. So we put them here on the merger because technically they are a merger, but it ends up being a public company. And 2021 was really the year of the SPAC. A SPAC is a special purpose acquisition corporation. It gets funded, it merges with a private company to become a public company. 23andMe, $3.5 billion in June. Luminar DX, excuse me, $3 billion at the end of last year. Mammoth public companies and M&A created here. But Jeff, why don't you give us, you know, kind of to the extent you can, an insider's view on how did Cantel Medical get to where it is? Is it a 2021 deal, or how many years was this in the making?
Yeah, and I would guess, other than probably the Twitter deal we all followed last week, that most public company acquisitions take a good year to come to fruition, right? It's very proportionately rare for a public company to really go through a formal process. They may put out, as we joke, sort of the swipe left or swipe right through a banker that they might be interested in a different phase. But the reality is, that's incredibly disruptive to a corporation who's public. And so getting a public company to change from its own internal strategy to really deciding that it's time to do an exit, largely then you're talking about an exit to another public company. So you got to find somebody else that's in position to capitalize a large acquisition and go through the time. Generally speaking, what I say is that those are long transactions. The documents themselves tend to be easy because public company acquisitions are like the great untold story in M&A. They're a lot easier than private company acquisitions to negotiate because you have to buy the whole thing. But in terms of getting that deal on the table and getting pricing, knowing that things are in flux is really interesting. What I say is it was a really healthy year given what was going on in the world at the time. So if you think about March of 2020 was when COVID became real for everybody. Everybody was refinancing. I think we did a refinancing at that point that was a couple $100 million. There was more financing activity that happened in the first 3 months of 2020 than it happened in the entire year of 2019. And 2019 had been a record year. So you think about the compounding superlatives in that, it was really an amazing period of time. And I do think that drove a lot of this acquisition. So you had a lot of companies sitting on a lot of cash who cleaned up their books. Everybody battened down the hatches preparing for COVID. A lot of us, Cantel, Steris, the Boston Scientifics, the strikers were all vulnerable to elective procedures. There was a lot of anxiety about what was going to happen with elective procedures. You came out of that in the fall and the winter then of 20 into 21, and a lot of people felt like things were going to get back to normal quickly. We had the vaccine, you had an election in the US, and I think a lot of people felt good, and a lot of companies were sitting on a lot of cash and trying to figure out what to do with it. The interest rates were great. So I think that was actually kind of the macro factor driving some of this M&A. In our case, that was about the timetable. So it took us a good 6 to 9 months to really get to a deal. Between sort of making that decision to bring other people in, knowing that that's going to cause leadership issues, right? If you've got a leadership team, you've got to be prepared. Once they know of M&A, people are going to be either in it to see the exit, or they're going to start thinking about running the company in a different way that's more cash generative. They're not going to make long-term investments because they're going to be thinking about the books, and they're going to be thinking about, if they don't get sold in the near term, they're going to start thinking about looking for another job. So these aren't things that you take lightly. In the case of our acquisition by Steris, I'd say, germane to this conversation, we had done a lot of prep work. We had thought a lot about our positioning. We had spent a good year modernizing our IP portfolio, making sure we could talk to it. We had cleaned the books on litigation. We had done a lot of things that were just good corporate practice, but also with at least a third of an eye towards, if there would ever be an exit for us, we'd want to make sure that we cleaned out the things we could. And those things don't happen quickly. So that was sort of our story in terms of the deal process itself. As you can imagine, in a public company, once you agree to price, pretty much everything is done. Again, we suffered a little bit with the volatility in the market. We did a stock valuation, so it wasn't a fixed price deal. So it was a number of shares for shares. So the valuation of the companies impacted a lot the transaction value. So that made it more interesting. It helped us fix a point in time, but it also, led to, as you can imagine, downstream implications when people are looking at relative value of stocks and trying to figure out if they've sort of put the right leverage into it. But any other questions on that, Dave or Roman, or for the team? I'm happy to answer it. It was a great experience. The general counsel for Steris, Adam, absolutely a fantastic leader. I think it was a good acquisition for both companies.
Well, it's certainly nice when you can say that almost a year out now that it really was a win-win. Those deals don't happen often.
Yeah.
Jeff, I have a question. So you said you kind of looked and modernized your patent portfolio. Can you talk a little bit more about that? Just in how you prepare the portfolio for an acquisition like this.
Sure. So, I mean, the biggest thing is making sure you have somebody who has their hands around the entire portfolio and is thinking holistically. Cantel was incredibly acquisitive. So we were routinely doing a deal a quarter, which for a $1.1 billion revenue company at that point, I think when I started, we were about 800 million in revenue. By the time we were done, we were over $1.1 billion in revenue. To do that, that's a lot of integrations. And what you don't want to be in a position is where you have a lot of dockets and portfolios out with 64 different outside counsel and prosecution histories that are sort of fighting with each other if you've got overlapping portfolios. And Jamie Ackley, who was our chief patent counsel at the time, really did a great job of pulling things together, making sure that we consolidated firms by technology, really making the portfolio of an inorganic portfolio work together like an organic portfolio across the three major franchises, as well as cleaning out some of the opposition work and some of the, what we call, we were lucky we didn't have any bet the company IP litigation, but we cleaned out a lot of the noise too, which was general good practice for us. That's a small balance sheet to carry an IP litigation on. So just being mindful to keep everything clean, make decisions that were in the best interest of focusing on the business and not on litigation.
Yeah, because we always see in deals like this, you're sometimes faced with a portfolio, you may have 500-600 patents and applications trying to figure out, and especially after previous acquisitions, trying to figure out what's important. And as you said, the deals take a long time as is, and just being able to present that story, I think is important, present it to the opposing counsel, kind of help them understand the portfolio.
That's right. And it goes back to the law of no surprises, right? The first thing that outside counsel for the acquirer side is going to do is run a title and a maintenance report, right? And if you put out a bunch of patents and you say these are all enforced and enforceable, and they come back with a report that knocks 18% of them out because maintenance fees haven't been paid, that's a pretty big shock. And in our case, we were having those conversations before we could bring the rest of the legal department under the tent. Right? It was a small company, about 2,100 employees. So for the legal department, I was the only one in the know when we started the management presentations. So for that, you've got to have a lot of confidence in your leaders to be focused and be able to give your reports that you can trust. And that you understand before you get into that process, sort of the strengths and the weaknesses of your portfolio, and that you've got that continuity and understanding of your portfolio before you ask somebody else to write a check for it.
But definitely I want to echo before the acquisition, in the portfolios, as it takes years to grow the portfolio, but things like getting the assignments, making sure the chain of title is clean, the maintenance fees are paid. Those are easy things that you can clean up. It just makes the process so much easier.
Easier, and your credibility. Again, it goes back to if you can show them a portfolio and you say these are all abandoned, and they are, that's great, right? Everybody will understand that you're making cost decisions. But if you hold out and you say we've got 3,400 issued patents and they're all enforceable and all paid, and it turns out 300 of those weren't paid in the last 9 months, whether it's the right answer for the business or not, you lose a lot of credibility from day one, and people are going to dig deeper into everything they see.
Right. Yeah, we represented investor, and the company was a relatively large deal, few $100 million deal, and the company represented, they have a license portfolio that covers this few hundred claims that cover their product. And obviously the next question was, so just tell us what claims do cover the product, and we just kept pushing and couldn't get the answer. And at the end they said, well, really this portfolio is for a potential contemplated product. And that once the investors hear that, then it's not just the IP, it's also now they start digging deeper into corporate and regulatory, into everything else, because you lose the management team loses that credibility. Better off saying, like, yeah, we licensed it, we thought we're going to build this product, the company went in a different direction, but it may still be a very valuable asset, but you have to be straightforward and honest with the investors, corporate acquirers.
And I think that's a great, between what Jeff and Roman said, that's a great first lesson learned here is that, no deal is perfect. No company's perfect. Everybody has some warts or some scars. And if you hide them, you can try to hide them, but if the deal is meaningful enough to an acquirer, they're going to find them in diligence. They're going to hire good law firms. They're going to have their R&D team. They're going to find the scars that you might have from some prior battles. And if they find them after you've ignored them, that's a much worse outcome than if you own them from the start and tell the story and set the narrative that, this is out there, but it's not a big deal. Those are two different ways to get to a deal, and probably the full disclosure deal is going to get done with a higher likelihood than trying to hide the ball and hope you can sneak it by someone. So I think with that, we want to look at what's going on in 2022. And this will lead to a big part of our discussion on the last bullet there about the BD spinning off embecta. But I think 2022, we're past the first quarter, we're starting the 5th month of the year. I think, the early story is that, the deals keep happening. And in some ways, the valuations have gotten better. Stryker made a big buy right in the beginning of the year, right before the JP Morgan Healthcare Conference, that they announced they're buying Vocera Communications for $3 billion to integrate them into their orthopedic and medical device line. Another trend we're seeing in March, Microsoft closed almost a $20 billion deal with Nuance. And what we're seeing over the last few years are non-traditional acquirers, whether it's Microsoft, Apple, Google, Fitbit. All these companies are new entrants that's making the M&A market much more competitive, pushing up valuations, and you really need to have strong offers to win some of these contests now for companies. A more traditional deal we saw in March that wasn't that traditional, Fresenius, which is obviously one of the leaders in kidney care across the US with dialysis and other kidney issues. They ended up doing a 3-way merger with 2 other companies and spinning out one of their units to create really a premier value-based kidney provider in the US. So that just happened a little over a month ago. And then the one where we want to get Jeff's take is BD's spinoff. It's officially on April 1st. It wasn't an April Fool's joke. Jeff worked very hard, but BD spun off its diabetes care unit into a separate public company, embecta. Right now, I checked this morning, the market cap is $1.7 billion. So Jeff, tell us a little bit about that to the extent you can. Obviously, you're a public company GC, but many of the documents are actually publicly available. So.
Yeah, no, it's thanks, Dave. It's I think a familiar story. We're certainly not the only spin. Zimmer did its own spin with ZimV a couple of months before us. There's been some in the ophthalmology area. GE now notoriously is spinning into 3. So, I think it's that natural pendulum shift where you're seeing companies have bought some technologies or grown some technologies that after they sort of see the business model come together, don't quite fit their strategy. And with all the cash in the marketplace and the access to capital, I think a lot of people are looking at it and saying these are great times to reset the portfolio of businesses that sit in some of the larger companies. In this case, the diabetes care business is what embecta was known as before the spin. Is an absolutely fantastic business. So about a year ago, we celebrated the 100th year of insulin as a therapeutic for folks living with type 1 and type 2. The more you learn about the horrors of living with this disease and the things it does to people before there was insulin, the more you appreciate what a breakthrough that was. And Becton Dickinson was the first to do delivery apparatus needles specifically for insulin back almost 80 years ago. So we're very excited and proud of the history. As you can see with embecta, the embecta continues to be a big piece of our heritage. In our case, we have manufacturing plants in Nebraska where there have been 4 generations of families working on the same plants in Nebraska, delivering these syringes and the life-saving insulin to 30 million patients and people living with diabetes per year. So it's an amazing story. It's an amazing history to stand on the shoulders of something incredible that was built up by Becton Dickinson. Today, we're excited because, as we know, when you've got a slower growing, so the rub on this business might be that it was slower growing than they wanted to. So it was sort of dilutive from a growth perspective. What happens is the overage or the sort of cash thrown off by the business every year gets reinvested in other businesses growing more quickly. And if you can't reinvest in the business, then that sort of perpetuates a no growth story, which perpetuates reinvestment everywhere, except in the diabetes. And then it just comes a certain point where you say, this is probably better. It's got a different call point. It's got a different trajectory than the rest of Becton Dickinson. And as great as the technology is, it's probably something we can do more with as its own entity. So April 1st, we launched as a public company on the NASDAQ, EMBC. This is really the first time in a very long time that this business can reinvest in its people, its products in the diabetes community. And we are really excited about this. There is a lot going on. We just got back from Spain at the ATTD conference. What has happened technologically from the days of what we call MDR. Glucose monitors and controlled by an algorithm to manage diabetes, especially for younger people living with diabetes. So parents can, understand what's really going on with the person's body and treatment patterns that look more like a Nest thermostat that adapt to your body and are able to control your glucose, sort of understanding how you respond to meals and exercise. It's a really exciting time. And we're thrilled to be part of the sort of 4 largest pure play public diabetes companies in the world. We've got almost half of our revenue is OUS. We're in 100 countries with sales. We've got 2,100 associates, manufacturing Nebraska, China, and Ireland. We're really excited about this, and there's a huge imperative for us to grow. We really want to be out adding to that field sales force, over 600 associates out there selling our embecta products, and we'd love to get more solutions to more people facing, the challenges of living every day with diabetes to make their life easier and unlimited. So we're really excited about what's out there. There's great technology that's ready. Sometimes the technology's ahead of the market. Sometimes the market's ahead of the technology, but we really think we can play a critical role in this, and finding companies with great IP strategies and structures will be a big part of that, no doubt, going forward.
Well, thank you for sharing the insider's view, Jeff. And it's a great segue, I think. These deals, IP is an important piece of the puzzle. While as patent attorneys, we like to say IP is driving the ship, and many times it's not, it's the market, but IP is an important piece for many of these reasons. It helps companies leverage innovation. You're spending all this money in R&D, you want to make sure you can block your competitors and hopefully increase your product sales. And again, as you're driving down the highway as a med tech or medical device company, you don't know what your destination is going to be. Is it going to be M&A? Is it going to be an IPO? Or is it going to be a joint venture and other collaborations? And IP gives you the assets. Patents give you the asset to kind of mark some territory as your own. And in sometimes you'll have willing collaborators. In other cases, it might be an unwilling collaborator where they have no choice but to take your patents, and that puts you in a position of power. And again, you can license or sell your IP. Certainly, as we've seen on Wall Street, I've been a patent attorney now for 25 years. Now everybody knows what patents are. It's the Shark Tank effect. You watch Shark Tank and they say, great idea, what's your patents? Now we go to cocktail parties. Before, people used to say, what does a patent attorney do? And now they say, I've got this great idea, can you help me? So I think it's a marketing advantage and patents move Wall Street. If you've noticed, I've saw some studies, there are so many more press releases now announcing an issued patent or announcing even a patent application filing because that's what the analysts on the street are watching. Who's driving innovation? Because ultimately, technology wins. We've seen that in medical devices. We've seen it outside of medical devices as well. And again, IP can only help increase your value for mergers, acquisitions, spin outs, or other investments, whether it's VC or private equity. I mean, Jeff, how do you view IP as a general counsel at some of these largest medical devices companies you've worked at?
Yeah, so I think for us, IP always is the one. If you made a list, there's probably only two things that can completely destroy valuation, quite like IP on the bad side. A lot of the other ones are deal models. We think about reimbursement, but it's product quality and IP are the two that really will differentiate a good deal from a great deal or a terrible deal. So we do tend in acquisitions to focus more on the freedom to operate piece foremost. Obviously, nobody wants to do a deal and face an injunction at the end or be surprised. No acquisition can really cover a defensive patent litigation and still have a good model from an accretion point of view. But the piece that I always like is, IP really helps you differentiate the ones who grew the technology from the fast followers. And so there are a lot of times when we'll talk, and I think it's a mistake that I've seen made a lot of times where you look for the thing that's cheap and you think that, because it's cheap, it's a good value. And people will often look at the company that built the market, either the first technology has the IP, and they'll say, well, that one is either in a process and we can't catch up to it, or it's X multiples. And I'll say, well, here's this fast follower. But you really build in that second fast follower product and you start looking at the compromises that are made, if they're smart to avoid the IP, or the risk you're facing at sort of coming out, launching a product and immediately being distracted by an IP litigation, having your first earnings call be tied to IP litigation. It's hard in the first instance to teach the M&A leadership or the business leadership that there's a huge disvalue or value destruction in that they need to understand. And so a lot of time, I don't think anybody's ever really gone wrong for buying the right company that built the market with the right portfolio in view of the cheap option. Sometimes you get lucky and you get the cheap one, but it seems to always be that you've got to really convince me if there's a crowded field and there's one company that really built up the portfolio and they have the cited patents that are, all over the references, they've built the market, that's not the right acquisition target in a sort of fast follower market.
Very good point. And Roman, from an IP patent attorney's perspective, follow up on what Jeff said.
Yeah, I agree with Jeff. Obviously, a strong patent portfolio can take you very far. You want to have your, the values in the technology, especially for a smaller company that has maybe one or two kind of products. You really betting on these products and want to make sure they're protected, and you don't have somebody else who's much bigger kind of come in and copy or get close to you. You really want to make sure it is a well-protected proprietary technology. But on the other hand, you do want to know what your landscape is, because a lot of times, even if you have a large patent portfolio, people sometimes kind of make that mistake is, because we have 20, 30 patents issued in this field, it means that we're in the clear, we can practice it. But that's a different, so even though you have 20 or 30, if your competitor has one or two strong patents in the field, you might not have freedom to operate. And that can also destroy the deal, because now you have to, there's a potential of litigation a lot of times, and that can be used as a business tool. Even if, maybe you do win the litigation ultimately, but if it's a larger company or if it's for some, that can destroy the deal. It takes the resources from innovation and it takes the resources from the sales. So definitely nobody wants to acquire litigation. And to prepare for that, you have to know, you have to do landscape, you have to do freedom to operate. Even if you find those patents, you want to know about them before due diligence. You don't want the opposing counsel to do a freedom to operate and present you with 5 patents that may be infringed. You really want to be, if there are those patents, there are ways, you can deal with it. Either you come up with an infringement opinion, and maybe if it's early in the design cycle, you can design around the patents, but it's definitely that knowledge is very valuable beforehand, before you go into due diligence.
Those are all great lessons. And as we're talking about building a strong portfolio, you can see the bullets. But one of the challenges is you need to decide a lot of these early on, especially the scope of coverage. And we face this issue a lot with a lot of early stage companies that might have a more limited IP budget. The earliest fundamental patents can be critically important. What Jeff talked about, those foundation patents that can dominate an industry for up to 20 years. But what countries do you go in? And oftentimes, we talked to even some of our clients this week, they've got a national phase patent deadline and said, do we really need to file in China? We're never going to sue anyone in China. What's the point? And what I said to them, and what you should take away from this, and Jeff can confirm, is it's not whether you need it in China, it's what does your potential acquirer, would they want it in China? And if you're unprotected in China, we've seen it many times in deals, a big acquirer will come back as, we're an international company. We want patents in China and Japan and Europe. And if you're bare in one of those countries, but in particular China, they're going to say, we love your technology. We love what you're doing. China is going to be a big market. You have no barriers to entry there. Someone's going to be a fast follower or knock off your device. So we might have to lower your valuation. So saving those few $1,000s on a China patent early on could come back to cost you hundreds of thousands or more down the road. So you really need to be thinking about the highway ahead, which is going to have many turns. It's never a straight line of building a company to an M&A exit or to an IPO. And we've seen that in diligence. We had another deal where the product was not approved yet in Europe, approved yet in the US, but it had the CE mark in Europe. They had European patents, but it turned out the key claims were in the US, and they didn't file a divisional application. They didn't file a second application in Europe. So the European patent didn't cover their commercial product they were selling. It covered a previous version of it. And what happened there, they didn't disclose that. It was found during diligence. The potential acquirer didn't necessarily believe us when we told them. And finally, when we pinned the company down, they admitted that their European patent that they had didn't cover their product. That deal ended up getting scuttled. 6 months later, it came back as version 2, which ended up being more favorable to our client, who was the acquirer. So I think it's little things can come back to have a big impact. So Jeff, what do you think about those type of situations?
No, I think that's exactly right, Dave. And the advice because it doesn't happen just in an IP context, because at some point somebody's just done a raise and they're trying to figure out, do I have $1 million to accelerate the product, or do I spend $1 million on the patent prosecution portfolio, or maybe it's $200,000? So I think, getting back to the opening comments, a lot of acquirers will be sensitive and understand that those things occur. Where you really need the counseling is to figure out the cost benefit, right? To think about when you're doing your nationalization decisions, if you have to make them, looking at your competitors, thinking 2 steps ahead as to who might acquire me, what does their supply chain look like, what do I think the markets for this are? And if you're not in a position to afford to make all these national stages, getting advice from folks like Roman and Dave and say, like, what are the decisions that I can defer, right? If I have $200,000 or $250,000 in my budget, how can I defer as much of this portfolio and those decisions to preserve flexibility as possible? What am I, might do my provisional and then go PCT and sort of try to run out as much of that 30-month clock as I can to try to preserve flexibility, and really working with your outside counsel to say, look, my goal is maximum flexibility. I probably don't need the issued patent today. I need a good indication of what I'll get allowed, but I also need maximum flexibility for an international portfolio that hasn't been cut off by not following a con. And that would be what we always love, is when you come in and you've got a good basis, but you still have a lot of nationalization decisions and some conversions, and the patents you really care about are live. And I'll 100% agree. When I hear a U.S. patent family doesn't have any live pending claims left, and it's part of the product, the original filings for the product, that makes me really nervous, because now I know I have to go back through every issued patent and figure out coverage and prosecution history, estoppel arguments, where if I've got a live family, I know I can write a targeted case. So 100% agree with that.
Yeah, and I wanna echo that's important. Keeping the families alive, because yes, it's more money, but you just don't know. Even the issued patents can be challenged. You know what's in the prosecution history. You don't know what's in the prior art. We had a case where we knew about the patent issued. We didn't think it's gonna issue, but it issued. It's now been challenged in the IPR, but they were able to file a continuation application. And again, it's good, we're going to destroy this patent and delay the process, but it's not. If that was the only patent, then that would be the end of the road for them. But now they still have the continuation application. If nothing else, there's still that uncertainty for our client. And again, unfortunately, we're on this side, but that's a good lesson to learn, to keep your families alive, because it gives you more options. And on the national side, I want to tell a story. We have a client where we did, as Jeff mentioned, we filed a provisional, then we filed a PCT application to kind of delay the nationalization decision. And during the pending of the PCT application, they got acquired by a large company. So we actually entered the national stage in 26 countries. And we would never, obviously, with the client, it's a hard decision to make, especially for a smaller company, to go into this many countries. So you have to find that balance, which markets are important, which markets you want to protect, because the large companies are everywhere and they want to file as much as they can, but obviously there's that, well, as much as I guess, Jeff, but that was there was 26 countries. Some countries I had to look up, but it was a very large national phase. But it's the balance.
And I think the lesson there is that the startup could never have supported that. That was a deeper bank account to do that. So I think it's keeping optionality and flexibility. And I think while it's true for patents, on this diligence list, there are a lot of things here that aren't patents where the same lesson should hold true. Negotiating an early license agreement with some crippling provisions, it's going to cause, a potential acquirer to roll their eyes and be really upset, especially if you're taking deals from potentially a university. Sometimes they have an acquisition fee built into their early stage license. When you sign it in the early days of the company, you don't care because it's not going to be coming out of your pocket, but an acquirer is going to care quite a bit. And you never want to be held hostage by any agreements you enter as well. I mean, Jeff, anything along the diligence lines?
No, I think we sort of covered it. I see some good questions popping in. So I think it's, keep it alive. Don't give up a U.S. case, particularly if it's filed on one of your commercialized products. And preserve flexibility and be smart, right? Study your competitors. Who's likely to acquire you? What is their supply chain? What does their go-to-market strategy look like? And really cover, pull, this is where I always do the plug, but pull your outside counsel in so you trust them too, right? If somebody came to me and said, we're going to file in 26 countries, I'd probably roll my eyes at the first time, like I probably did with Roman, but that's not my experience where it's valuable. But it doesn't mean it's not right for some companies. And I think that's where your outside counsel really has to know your business, your competitor's business. Where do they distribute? What's their big hub? Where's their input? Where do they manufacture? Where do they sell? Where are the markets growing? So that the portfolio really reflects the business. There's no one right answer for all businesses. Every business is different. And that's part of the value you bring in as inside counsel or a business leader. And it's the value that your outside counsel should be helping you to think through the optionality.
Yeah, and I think that's great. And one of the questions talks about trade secrets, and obviously those are critically important. And the lesson with trade secrets is the second word, secret. It's only a secret as long as it's kept a secret. So how do you deal with that during an acquisition? You don't tell the secret until the very, very, very end. You say you have trade secrets. You might say they're related to our manufacturing. They're related to this aspect of the product. But you don't list your trade secrets and you don't disclose them early. For acquisitions, we work with companies in this exact area. We execute something called a common interest agreement, and that's the very last thing disclosed. It might be a day before signing, it might be the day of signing. But you try to paper it so that it's not blowing the trade secret and blowing value. So I think that's that piece, and Jeff certainly dealt with that both at Cantel and embecta. There's a lot of trade secret in both of those deals that you need to get from one house to the other.
Mm-hmm.
So I think this is our summary slide. We still have a few minutes and we can answer some other questions. I don't know, Jeff, do you have anything that's on your mind here as we get to our last 5 minutes?
No, I think coordination's everything, right? To me, it's having grown up in IP and litigation and now doing more of the corporate world and now doing M&A myself. The biggest thing is keeping coordinated, right? As we talked about with your outside counsel in the 26 countries, there's no one answer for every country or every company. I'll hear Dave say things that occasionally make my blood curdle, like dominate the market. And now that I've been through 18 FTC reviews and Hatch-Waxman, you get through HSR filings and you start saying these are things I would never want in a slide deck. Woe unto my patent attorney that puts a slide deck together that says, with this portfolio you'll dominate the market, because I know there's another context to that where that's an incredibly harmful slide to put despite the best intentions, which is just an opportunity to say everything should be done in a way where people understand the business's goals, what you're trying to do, what your competitive landscape is, working with your outside counsel, invest in them. Invest in, we're scheduling an IP day for GT to come out and learn all about embecta, but it's really about making the investment, the outside counsel investing in the company investing in outside counsel, in-house counsel investing with the commercial team and the R&D team, really to have everybody know, because there's a great, smart people with a lot of experience, but if they're isolated from understanding the strategy, their advice is just, it's not going to be worth the full price. And so to me, the biggest thing is you look at filing strategy, the cons, all the things we talked about, how to do diligence, what does it really mean? You can't really assess those in a single silo. Those are really holistic company-wide decisions and strategy. And it's I think all of our businesses are very interesting and our outside counsel perspectives are always interesting. So I view IP as one of the most critical pieces of a diligence and an exit strategy, but it should always be done with a view of how does that patent strategy match the commercial strategy, and how does that commercial strategy match the potential acquirer or the IPO investor decks, and really saying, do you have a consistent story where all the pieces make sense and you can explain your decisions, even if somebody later disagrees with them, but they make sense in the context of where you were going at the time. And if you do that, I think that's probably 95% of the battle.
And I think those are great lessons. IP should never be viewed in a vacuum. You shouldn't be, is the extra 10,000 to file in this country, am I going to get ROI on that? It's part of the story. You build a patent portfolio that's got multi-layers of protection. No one patent is gonna stop someone who really wants to get around it. But if you have a web of patents, a real picket fence, that'll at least help keep people out or make it incredibly difficult for them to break down. And I think that's what IP really can do. I mean, Roman, as an insider on the patent side, what's your kind of takeaway message?
I think another point to think about it's a long-term investment, right? Patents are good for 20 years. And you might not think, again, if you're small, maybe you don't think some market is important, but you have to look ahead and try to predict, because again, this is gonna last, the patent's gonna last you 20 years. And if your strategy changes, if the product changes, like how do you make sure you maximize on it, even though maybe it's a little bit expensive to file the continuation application now, think about it, in 5 years as the company grows or gets acquired, you're going to look back and say, oh, we saved $1,000 because we didn't file, $5,000 because we didn't file this continuation. So you kind of have to look at it from that sense. Just think of it, it's a very long term, it's a 20-year investment. And a lot of patents become more valuable as as they get closer to the term. So you really have to think about it long term.
And I think we're approaching two, but a wrap-up question that pulls together a couple questions from the Q&A is, how do you value IP? I think it's, the message you've heard is holistically. You can't necessarily place a dollar value on each individual patent, and you'll have many decision points through its life. And that's another feature, is that companies should do IP audits. They should prune their portfolio, do a spring cleaning like you're doing in your garage. You probably need to do it on your patent portfolio. If patents don't cover where the product is going, it may not be the best use of the company's dollars. You might want to put them into filing new patents. So I think it's very holistic. IP valuations is sometimes the beauty is in the eye of the beholder, and there could be differences of opinion. There's no one right model. But ultimately, it's the whole product, the whole story that gets sold, and can create those billion-dollar valuations where Jeff Mann has been swimming in them the last few years. So, Jeff, what's your takeaway message here as we wrap things up?
Yeah, no, I mean, that's it. It's holistic. It's really finding partners. And so you didn't ask, but I'll say, the first thing I do in evaluating an M&A acquisition target, or it's outside counsel that we're hiring for a new company, is looking at whether they're dug in and they want to understand the business and they get it, and it's somebody that's smart and engaged. If it's a target, I can't tell you the number of pitches, just coming back from a Congress. And you can tell right away the folks who have done their homework can understand the IP landscape and the regulatory landscape and the obstacles to commercialization. And those automatically take 5 steps up in my book versus the company that says, hey, I've got this knockoff product or somebody else, but it's 75% of the price, and they haven't thought about everything. Same with IP counsel, right? It's not always the cheapest. It's you're looking for the best value. People are going to invest and make smart filing decisions, because picking the wrong counsel, you'll pay for it every quarter. Or you might pay a lot at the exit. So just making sure that you take a strategic view and a value-based assessment, and you're doing things that are in the best interest of the company as best you can understand it at the time, and you're transparent. And if you make deliberate decisions and you explain those decisions, whether you're the exiter or the acquirer, everybody's going to get it. And you just have to make sure you get good advisors to make sure you're thinking about it the right way.
Thanks, Jeff. And Roman, what's your takeaway message for the audience?
But I think from the patent attorney perspective, I think it's really becoming a partner with the company. That's my favorite part. Getting in, really learning the technology, understanding the technology, and helping the companies be strategic in how they protect their portfolio, how they build their portfolio. And I guess as a former engineer, I love going to the facilities, getting that tour, and going back to my early years. But that's just becoming a partner, a long-term partner. The companies, that's my favorite part of the job, and it allows us to provide value to our clients.
No, and first I want to thank Roman and Jeff. Jeff, thank you for giving us your time and sharing your insider's view, which is really just amazing. Some of the headline deals you've been involved in your whole career, but especially over the last few years. And we look forward to working with you on this next one. And I think if anyone has any questions, you see Roman and my emails there. We're happy to talk about you. We're both, medical device, medical technology patent attorneys, along with our team at Greenberg Traurig. It's pretty great, to be honest. We still have 80 people on, even though we've gone a few minutes over, which is outstanding. So thank you for going down this highway with us. And with that, we're going to turn it over to Nicole Owens to wrap things up from MassMedic's perspective.
Thanks so much. Great presentation. Thanks, Dave, Roman, Jeff. Thank you for bringing us this value. And, like you said, being partnered is important. We are grateful to be your partner in bringing this training to our members And thank you, Jeff, for all that insight. It was great to hear. If you want to stay in the know for upcoming programs, please check out massmedic.com. You can see upcoming events and register for them there. Everyone who registered for this session will get the video, so that will be coming out shortly. And thank you again to our sponsor, Greenberg Traurig. We can't do this without your support, so thank you. Have a great day, everyone.
Thank you. Bye-bye, everyone.